Hey everybody, and welcome back to H Invests. So what you're about to watch is a collaboration that I did with J Money, or Justin is his real name. So J Money runs a YouTube channel very similar to mine on finance, investing, and the stock market. We decided to have a collab. He has a really high quality channel, very passionate about stock market analysis and investing. I really recommend you guys check him out. Let us know what you think of the podcast, what you liked, because we're thinking of doing another one in the future. So please post your questions and thoughts in the comments, and I hope you guys enjoy.
Hey everybody, my name is Justin from J Money Channel. I'm here with Henry from H Invest, and we're excited to do a collaboration with you guys. And we're going to talk value investing, talk about the market, anything that kind of comes up in this video. Hopefully this will bring a lot of value to you guys. I've been on YouTube for about 6 months or so. Just fortunate to be able to do these collaborations and doing videos for you guys. And I'm an accountant. That's what I do as my day job. So hopefully I can bring some value on what I do and what I kind of see from my day-to-day stuff. So that's kind of who I am, and I'll pass it on to you, Henry.
Wonderful. Well, again, Justin, it's really awesome that we're doing this, and I just think having a collab with like-minded investors is really, really good, because it really helps you to think, right? Like in terms of what we're doing on our channels, you're kind of sat there, you're thinking about your investments, you're thinking, how am I going to pitch this? But having someone to kind of collab with, share thoughts with, and just get a general discussion with is really, really exciting. So it's my first collab, and very, very happy to have you on and for us to do this together. A little bit about me. So I'm H, or Henry. H is actually my official nickname. I don't think anybody on the channel actually knows that, but people do call me H. And so I'm 22. I'm currently studying and doing various things with investing and YouTube. And I've really enjoyed kind of sharing my thoughts so far. It's great to build an investing community on YouTube. And I'm excited to get this collab on the road, Justin.
Awesome. Yeah, I mean, we were just talking how really neat it is to be able to do this from across the world. So Henry's in London. I'm here in Colorado, the United States. So being able to do this through Zoom and have it live and working so well is really, really neat. So another kind of little background thing about me too is I've been investing for probably 20 years. I kind of started out in just kind of the mutual funds arena, and then probably about 2 years ago is kind of when I got into equities. And I've always been fascinated about the market as well. I've been really interested in stocks and the stock market, and so it's been a lot of fun. I mean, how about you, Henry? I mean, how long have you been investing? Kind of where did you start, or how did you start learning about the market?
Yeah, good question. So it was interesting because when I was thinking about this early this morning, it really made me think really, really far back. And it all started when one of my family friends, they just gave me a book, which was Rich Dad Poor Dad by Robert Kiyosaki. And I know it's many people's gateway into all of this stuff. And particularly when you're 10, 11 years old, you can't understand a lot of complex financial books, right? You have to ease into it. But Robert Kiyosaki's stuff was so easy to read. And I think that's where it all started for me, because it was the initial seed was kind of planted in my mind just to be able to think a little bit more divergently about money and about career choices, and just think about, you can go and have your job, and you can do the whole take home your pay and kind of work like that. But he talked about other kind of ways to make money, businesses, investing. I learned the things about passive income. That was kind of where it all started for me. And then when I turned 18 about 4 years ago and started university, then I had a small amount of savings and kind of just started playing around with it. I'll be really interested. What was your first investment that you bought, Justin, and why did you choose to buy it at the time?
So I didn't know what I was doing at all when I first started getting equities, and so I just bought my favorite company, and that was Apple.
Nice.
I love Apple. I love their products. And so that was my first purchase. And ironically, so I bought it and it went up like 50% in like, I don't know, it was like 6 months or something like that. It just started going up. And
Wow.
then I was watching somebody on CNBC, and they said, oh, if you have a stock that goes up, 20% within like 3 months, you need to sell it or sell most of it to get
Right.
your money. So I was like, oh, okay, well, that's an expert. I'll do what they said. And I just sold the Apple stock. Well, it's gone up like, I think fourfold since something like crazy like that.
Oh dear.
So that's what I get for listening to a so-called expert. But yeah, that was my first purchase, and I hit a home run.
Wow.
The one after I did after that was not a home run, but that one was home run. That was just luck. I didn't know what I was doing and just kind of bought in. So I'm kind of curious, what was your first stock that
Oh,
you bought ever?
okay. This is actually really interesting because like I feel like I was really unconventional in terms of being an 18-year-old investor. And I say that because we're talking like 2017, right? Like CFD platforms like Trading 212 were in the full swing. It was like the midst of the big Bitcoin bubble and crash. Like that was when I started university and started doing all of this stuff. But I was very different. And I don't know why that kind of happened. Maybe it was because I had some like fund management experience, and maybe I don't know, I was more interested in the slow wealth building than making a quick buck. I treat it as a very long haul journey. But my first investment was a UK based company called Primary Health Properties, and they basically they have a big property portfolio of like hospitals and like general practitioner surgeries, so like doctors and stuff, and they lease it to the government. They literally lease the property to the government, and it was a REIT, so real estate investment trusts. I think it's the same in the US, but in the UK, they're legally obliged to pay 90% of their rental income out as dividends because you're technically an estate holder, right? Like I technically owned like a few bricks of a hospital, basically. And the reason why I said it was like so unconventional is, as I said, everyone else was, doing Bitcoin and leveraging stuff. And I was sitting there with Primary Health Properties paying me a good dividend, but the most boring, unexciting, slow growth company it was. And every 4 months, I remember I'd get my £7 a quarter in dividends. And the stock did quite well over time, but it was a very slow investment. And I think that was just a function of where I was coming at with investing. I was aware that if you play this game with the mindset of low expectations, you're building your wealth slowly, for sure work hard at it, then you tend to be much better than if you go in with this mindset, I'll have to triple my money in the next 3 months. You probably take excessive risk and you might get burned out, right? I'm trying to think off the top of my head, but I think Charlie Munger said like it's just very, very easy to get rich slowly because you lower your expectation, you take all the emotion out of investing, you're realistic with your financial goals, and also the odds are in your favor over time, right? Like stock markets go up as GDP goes up and the economy grows over a long period of time. And that was my first stock pick, Primary Health Properties. And 4 years later, I'm still investing.
Well, yeah, I said something, actually a couple of interesting things there. So one is, the Charlie Munger, making money slow, not trying to get that quick, hit and try to double your money, in 3 months, that sort of thing. I kind of think, with the long-term investing approach, I think we both have, it's kind of that crock pot, approach where it's like, okay, just slowly boil. It takes a long time to heat up, but you're going to get there eventually, and not kind of using the microwave process where you're just throwing something in, trying to heat it up. And and I know personally, like, I've had 2 really bad investments, and one of those was short term. So it seems like, I saw a stat one time that like, day traders, they lose on average, I think it's like 85-90%, something like that, right, over time. And it's really hard to, in my opinion, to kind of guess, how companies are going to do in the short term. I mean, you look at, a chart price, any really stock that's out there, on a given year, it's, up and down 50%, and which is a huge, fluctuation. So obviously, if you buy on that low end of the 50%, you're going to do really well. You buy on the high end of the 50%, you're going to, not do very well, no matter what kind of company you buy. And so, yeah, I think the long-term viewpoint is much easier. It's I think easier to tell how a company's going to do over the next 5 years versus 3 months. And another thing that you said too is interesting was you said your fund experience. Can you talk a little bit about what that fund experience is and what you did?
Right. So this was literally, I was very lucky in this because I don't have a family that kind of comes from finance or anything. This was just by sheer coincidence and maybe by a little bit of sweet talk that I managed to get some experience before I got to university. Like I've had some other like internships and stuff since then, but before I went to university, I basically met a fund manager or literally on the street. Like, didn't know him. Hi, how are you doing? And for some reason, we just got talking. I said, look, I'm about to go study economics at university. And he said, look, I run a fund in the town, which is very unusual because I'm from a tiny town. And it turned out these guys have billions under asset management. Their names were Even Load Investment. And I just went there for a couple of weeks. They taught me some very basic things. I didn't know what a PE was. I didn't even know what a dividend yield was. Or anything like that. But they taught me some basic things. They gave me a lot of education. They asked me to do some stock analysis and listen to some earnings calls. And I think it really gave me a grounding in like how the professionals do it before I enter the market myself. So that was kind of my fund experience, which was really, really interesting. I can imagine with regards to you, Justin, your accounting experience definitely like helps, particularly on the financial side of analyzing companies, right? Just being able to really like look at their balance sheet and be like snapshot, like boom, this company is financially healthy or this company is not financially healthy.
Yeah, I definitely think it's given me I think an edge in the beginning. I think everybody, no one needs to be like an accountant to be able to, look at financial statements and kind of gauge how companies are doing, but certainly like up front, because I had no idea what I was doing, when I started getting equities and trying how to value companies and what to look for. And so this has all been like self-taught for me. And one of the best things I did is I picked up a book called Rule 1 Investing by Phil Towns. And I've read a bunch of books. I mean, there's a Don to Investor by Monish Pabrai, which is really good. Joel Greenblatt has one about, the book that, beats the market. So there's a lot of great ones out there, but the Rule 1 Investing book definitely just kind of changed, or at least taught me how to invest and what to look for. Phil Town talks about like the 4 M's, which is like the meaning, the moat, management, and then margin of safety. And the book does really good about going through and how to discover those. But what I found that is a lot of people don't want to put the time in. First, they may not know what they're looking for, but a lot of people don't want to put the time in researching companies. And I think,
right,
especially from like the financial, statements and financial view, it's that just takes time. And I think people kind of get overwhelmed from that. And fortunately and unfortunately, I think that's where companies or investments can make or break you, right? It's really important to know where the company has been, and the numbers can tell you that, and they can also tell you kind of where the company is going. I had a very actually controversial video that I put out here in the last couple of days that I've actually have more dislikes on the video than likes, which is the first time that's ever happened.
Right.
And I went through and I did a very deep analysis on the income statement over the last 4 years. And I looked at different metrics, ROIC, profit margin, gross margin, to kind of show where the company has been and which can be a good indication where the company is going out into the future. And a lot of people, it seem like, are just dismissing all that or upset kind of about that. But, I truly believe, financial statements have a strong impact and should be, part of your valuation process and one of your first valuation process in my personal mind, but I'm also kind of a numbers guy as well. So I do think it gave me an edge in the beginning, but I think anyone can, with the right education, right training, can get to even where I'm at now. I mean, even watching your videos, I mean, you do strong deep dive analysis. I mean, one of your best ones you've done was the Lockheed Martin analysis.
Cool.
That you went and did a deep dive on that. And I'm kind of curious from your standpoint as far as like valuations go. I mean, how do you come up with a valuation? How do you come up with like a target price of a company on knowing what to buy? And then on the adverse effect of that, how do you know when to sell? So what is kind of your process on what your buy point is? And then what is your process on sell? Because I think a lot of people don't know how to value companies. And then when they do buy companies, they don't know when to sell companies. And I think that this part could definitely be valuable to people that are watching this.
Sure. Yeah, I think the question you just asked is really going to get into the meat of our investing and really get into the deep part of it. I think I'll preface it by saying, like, for me, valuation and price targets are incredibly important. And that's because, like, as you said, right, you were going through stuff rationally, but people, for whatever reason, they weren't agreeing with you, and that's all fine. But I think what it points to is that, like, as humans, we're not rational computers, right? We're very, very behavioral, very emotional, and there's always going to be biases in our decisions. Like always, because like what I've experienced and what you've experienced is like 0.0001% of whatever you could experience, and to make judgments off that in the whole world when you've experienced such a small amount, it is never going to be that accurate. So my point is that as humans, there's always going to be inherent biases. And that is why valuation is so important. And that is also why the margin of safety that you mentioned from Phil Town is so important, because you don't want to invest in a company if it's like 1% undervalued, because there might be an error, right? There could be if there was a 5% error in your valuation and it was actually, you got it 5% too cheap and you got it as 1% undervalued, then actually you're getting it as about 4% overvalued, if you see what I mean. So you want to invest in companies at a deep discount. So that's the first part of the answer. That's why I think valuation is important. And it gives you this objectivity framework, right? It takes all of the stress out of investing. If you have company X trading at $100 and you have strong conviction, it's valued in the range of kind of $140 to $150. That's a really good margin of safety, right? That's like 40-50% upside. And then you go and buy it and you don't stress about it. And if it's a quality company and you're right and you have conviction and it goes down to 90, you don't stress, you don't worry, you don't sell, unless anything is fundamentally changed about the company that would change your valuation metrics. And then you have to say, let's not be stubborn and let's cut our losses and get rid of this. And then you sell it. When it kind of reaches its fair value, you can do the kind of dollar cost average and reduce a bit of your position as you go up if you want to. I usually, as I mentioned to you before, I do the selling covered calls, and you do too, right? Where you're selling covered call options, which basically that also keeps you in real discipline, right? So going back to this example, you have a company trading at 100. Well, you wouldn't be able to sell 140 calls at that because they're so far out. You just wouldn't get any premium for it. But if the company went up to 130, you're thinking, right, it's getting close to my fair value range. Then I can go and sell a covered call with a strike of 140. If my range was 140 to 150, I might sell half of the position with a strike of 140, half of it with a strike of 150. And then if the stock goes in the money, then you're disciplined because you're obligated to sell the shares at that price. And if it goes up to 160, who cares? You might have missed out on that gain, but you're being objective and you're being true to your rationale. And that takes all of the stress out of investing. So that's why I think valuation is important. In terms of, is there anything you wanted to add before I go deeper onto kind of how I value companies, Justin?
No, keep going. I'll kind of add after you're done.
All right, wonderful. And then in terms of kind of how I value them, you guys might have seen this if you've watched any of my videos because I go through it. The DCF is still something that I use very, very heavily because free cash flow is free cash flow, right? Like after, once a company has its operating profit and it spends on everything it needs to keep it in business, that free cash flow is what it is for the business to do whatever it wants, whether it's reward shareholders or rebuild its new project. That's the real key metric you want to be looking at. Very powerful tool. So I'm still all for discounted free cash flows. I definitely look at them. I think it's very important to look at the EPS. The number one reason why I look at earnings per share so much and where that is forecasted is it's usually the key figure when the earnings calls come out, right? Like if the company beats earnings per share, the stock often goes up, and it's just usually the most heavily watched figure by all the analysts. They all talk about what the EPS is going to be. So I look at that, and then the way that you get an intrinsic valuation from that is very simple. You just multiply it by what you think the PE ratio is going to be. And that's very easy to do if you have a company that's relatively stable, which is why you tend to see me analyze more of these companies with like consistent PE ranges that I can easily like multiply that by what I think the EPS is going to be and come up with my target price. That's another thing that I do. I also discount those earnings per share at whatever rate I think is appropriate. But just because, a dollar tomorrow isn't worth the same as a dollar today because of the opportunity cost. I then, for those two methods, I also give myself a range. This is something that's very important because I didn't used to do this, and it's been one of the biggest improvements in my investing. Is I give a range of values where I think this is undervalued and this is overvalued. Like I build a matrix where I alter the growth rate, I alter the discount rate, and say this is what you could get at different values. I used to just build the one, and that is all fine, like building the one if you get like a deep undervaluation. But the problem is that these valuation methods are very sensitive to what you choose as growth and what you choose as a discount rate. And by having the range, it's really useful to see what the company would be valued under different scenarios, right? If I valued a company 7% growth at 7% discount rate, and it was like 50% undervalued, that would be great. But what if a discount rate is 9%? What if a discount rate is 10%? If I valued it growing at nothing and the discount rate at 10% and it's still undervalued, that gives me a lot more confidence than if there's a much wider range and there's many discount rates and slow growth rates there, they would actually be overvalued instead of undervalued. I have some more I could add, but honestly, I'd be interested to hear your key areas of evaluation methods, Justin, and then we can carry on from there.
Yeah, definitely. And actually, that might be a good video for you in the future as far as kind of showing how you go through your discounted free cash flow valuation. I think that could be really valuable for a lot of people. Yeah. So as far as like, buying, selling stocks and valuation. So for me, it's really important, obviously, to know what the value of a stock is. And, Warren Buffett has always said that, he actually reads through like the 10K and gets, a really good understanding of the business, and then, looks at, valuation and determines, whether it's a good buy or not. I probably, sometimes I get myself, I kind of put the horse in front of the cart where I kind of try to do the valuation first and then go look at the business, which is not always the best thing to do. Mm-hmm. So as far as valuation goes, there's a few different methods I actually use. So depending on what the company is, and actually a lot of time I'll do all of them and then kind of see where it falls out. But one is a margin of safety analysis. So basically it's looking at the earnings per share. So like you talked about, the earnings per share is really is the most important piece of valuing a company, because earnings is what drives stock prices. Over a long period of time, you look at, over a year's worth of time, it can be all over the place. And I think it's Warren Buffett that talked about, stock price doesn't equal value, right? Stock price is just kind of what you pay for the company. Value is what the company is actually intrinsically worth. So the margin of safety kind of looks at the earnings per share. It looks at kind of the PE over the last 5 years. It kind of does an average there. And then looks at growth rate, and growth rate can be difficult from time to time depending on the company. You can look at what analysts think. Sometimes you got to look at what you own think, and kind of do a calculation from there. And also kind of giving you a margin of safety. And you said this too, but saying, okay, what is the intrinsic value of this company? And then trying to discount that, 30% or 50%, giving you that margin of safety. in
Sure.
case you're wrong, right?
Right.
It's all a guessing game. Growth rates are a guessing game. The past PE doesn't actually mean that's going to be the forward PE. So that's one. So margin of safety. Another one I look at too is the 10 cap valuation method. That's kind of Phil Towns, thing that he does, and that looks at the cash flow, looks at the income statement. Really, it's really looking at owner's equity on how much of the company is worth now. And then he also has a payback time method as well, too, trying to figure out, okay, if you buy these shares now, how long does it take you to make your money back on these shares? So I'm always trying to look at companies that are in the 7-8 year range or below. But there's a lot of different valuation methods, and I think it's prudent to kind of do multiple at the same time and kind of see where it all kind of falls out. And once I find that buy price, what I typically do is I buy, a chunk of that company, and then I also try to sell some puts too. So let's say, a stock I determine that the buy price is, $15 is my target price, and the company is right at maybe, $15. So I buy a little bit. I might go out and sell some puts maybe at 14, trying to get a little more discount on that, collect some premium. And then kind of like you said before, selling covered calls. Once, I say, okay, the stock price is worth 15. I have the intrinsic value maybe as $30. And so once it gets up to 30, I might start selling, call options at that point, collect some premiums. And then if it gets above that strike price, that gets called away from me. And actually, Warren Buffett does that. I really didn't know that until, I started reading Phil Towns' books, and I actually did he has a 3-day course that I took back in October.
Nice.
And I had no idea that Warren Buffett does that. In fact, it's right in his 10K. I forgot what it's labeled as. It doesn't say like option contracts. I forgot what it's called, but that's what he does, because selling put options, selling call options, you're basically the house. I mean, you get to collect those premiums, and no matter what happens, you win, because you're either buying that, getting that, stock put to you at the price that you wanted to, plus you got those premiums. And it's a really, really great way to discount your investment, right? So I was watching a podcast by Phil Towns a couple months ago on Boeing, and he was able to actually get Boeing for less than $100 a share, and it's trading at like $240 right now by using, put option strategies. So it can be really, really powerful, but it's really extremely important to know what the buy price is and kind of what your sell price is going into the future. So I'm kind of curious for you, Henry. I mean, what is your kind of favorite stock in the market right now? I mean, what if you had to pick one stock, what is your highest conviction stock that you have, and why?
Yeah, I thought we were going to talk about this. This is a very, very interesting question, and it's a shame. Well, it's not a shame. It's good for me, because there are a lot of stocks that I could talk about, which I really love the fundamentals of them, and I love the company, and they were at deep valuations, but because we've been in such a bull market, they're actually approaching fair value. So I could say, oh, they're like my top conviction, but they don't have much upside left in them. And now I'm at the stage where I'm doing the selling the cover calls and trying to kind of reduce my exposure on them. But yeah, it's quite interesting, because the stock market, in my opinion, I think we're at really, really high valuations at the moment. And particularly with just everything has been real on a bull run. It's been quite hard to find the same kind of deep discounts that you would usually find. One stock that I can talk about, which I am quite bullish on because it's a hedge against the stock market crashing, is the gold company, Kirkland Lake Gold. So we spoke about this briefly before, and it's a stock that I've held for a long time. I guess not necessarily because you have some conviction on the technology that's going to go to the moon or whatever. The stock's going to take over the world and be the next Facebook. But the conviction on it is a hedge, because it's a gold company, right? And it's in my opinion, it's important to, particularly if you're very stock heavy, like me, and a lot of your kind of assets are in stocks, you want that kind of diversification. And I like the fact that Kirkland's, it's gold, so it's an alternative. But it's not just that. Like they are really growing very organically, as well as being sensitive to the gold price. So the way that gold companies work is obviously they are very leveraged businesses where they have really high operational gearing, really high fixed costs because you've got to go and mine stuff, right? And that takes a lot of upfront costs. So what you'll tend to see is that when the gold price goes up and down, these gold miners, they often act as like a leverage of it. So for example, like if the gold price goes up 1%, a lot of gold stocks might go up 2%. When the gold price goes down, these stocks usually go down by double. But what does that mean? That means that if you have a gold company that's growing really well organically, and what it's actually doing in terms of its quantity of production matters a lot more than the actual gold price, then that can create a massive undervaluation opportunity. These leveraged like moves, they happen because these gold companies are so overwhelmingly owned by ETFs that just like passively like buy and sell them, right? So that's why I'm pretty bullish on Coconut Lake Gold, is that we haven't seen a great run on gold over the last 6 months, and them being pulled down so much when most of their growth is actually organic, I find really interesting. And I think there's an opportunity there. I did this thing called revenue sensitivity analysis, where you look at like where their revenue is being driven from. And only about 30% of it was being driven from changes in gold prices. And about 70% of it was organic production growth. So that's a real positive for Coconut Lake Gold. Do the whole valuation thing. I see it's cheap objectively. You get a yield on it. Obviously, you don't get a yield on gold in terms of the raw money coming in. And they pay a good dividend, which is on the upside of 1%. It's nearly at 2% they yield at the moment, I think. And in terms of the actual company, they caught my attention initially because they have really, really high return on invested capital, very high margins. Then you look for an economic moat off the back of that, because these two things are usually good indicators of an economic moat. And basically what it is they have access to really, really high grade gold. So if you have really high grade gold, which basically means you have more gold per ton in the rock than the average, right? Their grade of gold was like 15 to 30 grams per ton, as opposed to the world average, which is like 4 to 6 grams per ton. Then that means that, you know, it's the same cost of like drilling a ton of rock out the ground, but you get more profit because there's more gold in that rock. And that's kind of where their economic advantage lay. And that's why they were able to get so high returns. I also like the fact that they were mining out of Canada and Australia, which are pretty low risk countries geopolitically. Australia in particular, it's not had much COVID risk at all. That's pretty much Coconut Lake Gold. What do you think, Justin?
Actually, because I looked into Coconut Lake Gold before too, and I think we're both on the same page that, you know, the market is, you know, definitely overvalued right now. Right. And I think, you know, there's a lot of debate right now as far as inflation goes. You know, is inflation going up? Is it going down? And gold is a really good hedge against inflation, right? And for me, I don't know how inflation is not happening, or how is it not going to grow going on into the future. I mean, I think Fed Powell's talked about, or Powell's just talked about, hey, you know, it's going to go up, I think 2%, or they're going to try to keep it around that. But with all the money that's being printed, I mean, $1.9 trillion in the United States, you know, it has to go up. I mean, people have all this extra money and spending. I mean, we're seeing these numbers that are going on that are, you know, the quarter one releases from these companies' earnings over the last week. I mean, a lot of these companies are just beating estimates. And a lot of it has to do with all the stimulus money pumped into the economy. So I don't know how there's not inflation going on. You know, and so I think that could be a really good company to go with. And I think they're trading under $40 right now, last time I looked. So yeah, I think they could be pretty good value. I know for me, there's there's two really high conviction stocks that I personally have, and I was kind of going back and forth which one I wanted to talk about. And I decided to actually go with Huntington Ingalls, ticker symbol HII. And the reason for that is, you know, I think there could be a lot of volatility in the market for this upcoming year. And I think it's not, that stock in particular is not going to be very volatile.
Right.
It's basically a ship maker. They design, they manufacture warships for the U.S. Navy, and they're actually the only one that builds aircraft carriers for the U.S. Navy, and only one of two companies that build submarines. So their moat is just massive. And I talked about that company going back to October. They were trading around like 140 at that time, 140, 150. And then actually just in January, they dropped back down into the 150s again. With, the Biden administration coming on, there was a lot of fear about, maybe Democrats might take money from the defensive sector. We just saw, Lockheed Martin, we saw Northrop Grumman, a lot of those defensive sector stocks just dropped, but they've been recovering very, very quickly overall.
Sure.
But Huntington Eagles, the reason why it stood out to me so much last October is that they went through an event last year with the whole Rona situation, where all of a sudden 65% or I guess it was 65% attendance over the second quarter, because a lot of people got sick, and it basically, with them building ships, it pushed out when they were going to have ships built going out to the future. So all their revenue and earnings got pushed out, and a lot of the hedge funds just jumped out of that stock. I mean, it went from $280 a share down to like below 140 in a very, very short amount. It went down really, really fast. And I looked at the company, they had a $45 billion backlog going out to 2032. And it was just this little bump in the road, and their operating profit margins, historically have been around like 7%, and it dropped down to 2%, during that time.
Right.
But even the last quarter, they were up around like 11%. So they've recovered very quickly. It's just that most of their ships aren't going to be built and furnished to the government, until like 2022. I think they're releasing 3 ships. I think there's one in 2021. Sure. I think right now they're trading around like $210. When I did my intrinsic value of the company, it came out to be like, 270, 280. But the CEOs actually talked about getting profit margins up consistently over 10. And again, historically, they've been around 7. So if they can do that, I think their intrinsic value is probably around 320 plus, even close up to 350 potentially. Plus they pay out like a 2% dividend. So, and defense sector too is one of those companies, or just sectors in general, where if we do have some volatility in the market going out, they don't tend to get hit as hard generally as the market. So it can be, I won't say considered a hedge, but it definitely kind of a safety net compared to some of these other companies that are out there.
Yeah.
So that's thoughts about Huntington Eagles. I still think it has a good ways to go as far as the run too. But I would be kind of curious from your standpoint, what was your worst investment that you made, and why? What happened?
What was my worst investment that we made? Okay. I will let you guys on to a little secret here, and it's a very, very important secret, is that I need to be burned as an investor. Like in the sense that like I need to have one of these situations where I am down like 40, 50%. I really do. And it like just because I want to see how I'm going to react to it. Like I know I'm going to lose money. But I need to have that psychology, and maybe it's coming because, as Justin said, I think we're both on the same page. We think the stock market is a bit expensive. I'm very, very well prepared for that scenario in my portfolio, as opposed to high growth. But who knows? Like your stocks can go down like 30, 40%. The thing is that it just hasn't happened to me in 4 years, which is unusual. And like I don't know, maybe I've been right a lot, but the truth is that like, that's not when you're like really tested as an investor, because everything's great when you're all making money. And what I don't want it to do is I don't want the fact that I haven't had a massive bad investment yet to like get me into this like overconfident cycle and then not know how to deal with it when I had a really, really bad loss. I guess one thing you could say that might have been a bit of a mistake for me. So back in March 2020, we had the massive like COVID crash, right? And there were some things that I really heavily invested in, which went in well. But then there were other things that were kind of like high growth stocks that I then I sold out of purely because I thought that people were being too optimistic with the stock market recovery. If I just bring up the S&P 500 now, because it'd be interesting to look at this. We crashed like March, right? And then by June, we were above the COVID crash. And in June, I thought some of these tech stocks that I own, with their high betas and their kind of like high valuations and their high volatility, are not going to be able to, are not going to do that well if we have another crash. So I liquidated a lot of those. And since then, they've done very well. The two that I liquidated were Facebook and Skyworks. And Facebook, I was back in for a time. I bought them back at like 250. Skyworks, I'm not in, and that's done very well. But hey, like the past is the past. And at that time, I think I had good reason to believe that even then, I thought the stock market was still very, very expensive. Since then, we've seen an absolute roar. But yeah, that would probably be the biggest mistake that I've had, is like selling out of stocks that have then since done incredibly well. But to answer your question, I need to have that experience where I'm burned to see how I deal with it, to see how my emotions are reacting when I'm down like 30, 40%. I guess I had that with Kirkland a little bit, because I bought them at like 35, like way back in like May 2020 when everything was really cheap. And then back in August, I was up 50, 60%, and they were trading at like $50, $60. And then they went all the way down to like 32. And I said, hey, this is a gold hedge. Nothing fundamentals changed about the company. And I was down at the most about 16 or 17%. And now I'm above my break even again. So I guess that was a bit of a test of a strong stomach. But I'm looking forward to, I don't know if that's the right thing to say. I am appreciative of that. When I have that kind of experience, that's what really tests you as an investor in this strong stomach. When your stocks are down 50%, there's two things going on. If you are wrong and something's changed about the company that's altered your decision, do you have the humility to say, right, I'm wrong, I'm going to get out of this position? Or if your valuation models are holding up and your conviction is holding up, do you have the strength to hold on to something when it is plummeting and say, hey, I have strong conviction this price and the value of this stock is much higher and it will return to its fair value in the future?
Well, that's actually, yeah, I mean, that's a great thing to say. So, I think right now with there's a lot of new investors that have come into the market. You look at, towards the end of 2019 till now, I think, with Robinhood, it's made it so easy for people. And I don't know, can you have Robinhood in London, or is that you guys access that at all?
I don't think you can. I'm not actually sure. I think it got very close to being passed at the moment, but I know it was like only passed in the US for a long period of time.
Okay.
I'm really not sure. I'm not in the CFD space at all, but I know what it is. We have the British equivalents over here, like eToro Trading Tool too. And I know it's been very popular in 2020, and they have gamified a lot of the investing space. But sorry, carry on with what you're going to say.
Yeah, because I think I used Robinhood just for a little bit to try it out. But they make it so easy to go on and buy stocks. I mean, you literally, it's kind of like, I think of like Amazon. Amazon made it so easy to buy stuff. You can like just click a button and you bought it,
Right.
Robinhood, you just swipe and you buy something. I mean, there's, you don't have to go through multiple screens to buy something.
Sure.
And so I think it's really brought a lot of new investors into the market. And, and for me, like, when I buy into a company, I got to have really, really high conviction. And even when stocks go down, I mean, even all the volatility we saw even the last 2 weeks, there were some stocks that dropped and people reaching out to me on my YouTube channel. Are you still buying this? Are you selling this? And it's like, actually, if
right.
I drop below what my price point was, I'm going to buy more because I know where it's going to go, eventually. And so again, it goes back to knowing how much the company's value is, and knowing where it's going to go into the future, and I think, I wish I didn't have, you talked about not having, huge losses necessarily. I had one really big loss. In fact, I've had two big losses. One of which was I was trying to do kind of short-term trading and seeing if I can, make money, and that totally backfired on me. But that my biggest loss was Tailored Brands, ticker symbol TLRD, I believe. And so it was actually my second purchase. So my first purchase was Apple, which was really, really good. And then my second purchase was Tailored Brands, which in the United States, that's a company that owns Men's Warehouse, Joseph A. Bank, K&G.
Oh,
Basically,
okay. Retail.
You can go, buy suits or rent suits or tuxedos for weddings. And they have a really old business model. So, I mean, they think they were founded back in the 70s. So the 70s, 80s, 90s, they were doing really well. So if you, and really, the work environment has transitioned so much over the last 2 decades. I mean, since I've gotten out of school, I mean, there's never been a place where I've had to wear a suit. I've never, had to wear a tie.
Really?
I can, even the company I work for now, I can go in some jeans and a t-shirt and they wouldn't really care.
And it's going to change even more because of COVID, right?
Yeah, exactly. I work from home. 2 days a week even. So that's a good point too. So the need, the necessity for Men's Warehouse is not there anymore, and they haven't changed their business model. And so, and even when, men that wear nice long sleeve shirts, a lot of times they don't even tuck them anymore. They just, and so, so their business model is just kind of old, and they've suffered because of it. And when I looked at them, their stock had gone from $66 a share down to like $9 a share, something like that.
Really?
And when I looked at it, their dividend was 12%. And I was like, as a new investor, not knowing what I was doing, I was like, wow, if I buy into this company, even if they don't make, their stock doesn't go up, I make 12%. This is amazing. This is a gold mine, And so I bought into the company, and lo and behold, like 2 or 3 days after I bought in, they had their first earnings call. Yeah. And I was like, oh, I'm going to listen to my first earnings call. This will be fun. And even as a novice investor, I was listening, and it was like everything was collapsing. I mean, they were selling off one of their brands. They were looking at closing some of their stores. They were hiring a consultant to come in and restructure their company. And I was like, okay, I may not know much about stocks, but I know this is not good. What's happening? And then the very end of the conference call, they said they're cutting their dividend completely. So that 12% gone because they can't pay their bills. In fact, just in the last year, Tailored Brands went bankrupt. And so their stock went from like $9 to like, I think it was $4 or $5 in a short amount of time. So I lost a lot of money. I think I got out maybe it was like $6, but I lost a lot of money in a short amount of time. Luckily, I didn't put a lot of money in there. I didn't have a lot of money at the time. So it's good to make those mistakes when you don't have money. But it's not, so that's why it's important to go through your whole due diligence and, and valuing a company and look in and understand the business, what's going on. And it's, and a lot of things with the market right now too. I'm part of a lot of the Facebook forums that are out there with people, wanting, asking for information, what kind of stocks to buy and that sort of thing. And a lot of these penny stocks, all these, stocks that people, are looking to make a quick buck on, those are the ones that are being talked about. And it seems like even the last 2 weeks when we had kind of overall the market has dipped, but these penny stocks have just crashed. They've kind of come back a little bit the last couple of days. But I feel bad for a lot of people because they're looking and they might be buying at a high point, and then all of a sudden they're kind of freaking out and selling at a low point because they don't know the business model, maybe where they're kind of going overall. But when you look at the market right now, are you kind of still trying to find companies that are on sale, or are you trying to find companies that are fair value but that are still great companies out there? How are you kind of looking at that right now?
Okay, sure. Really good question. So there are two things to bear. There are two ways you can think about what is going to happen when there's a market crash. You can think about, I can still go and buy quality companies at quality prices, and who cares if there's a crash, because I still think they're undervalued, and eventually, they will be fine, basically, and they will, go up and they'll reach their intrinsic value, and boom, we make the money. There's that way to think about it, and that, the Mr. Market way of thinking, if I buy a stock and the market crashes, I've still bought this stock at what I think is a cheap price, And someday Mr. Market will offer me the fair value, which is far above what I bought it for. So there's that way to think about it. But then there's also the way to think about it. Look, let's be really rational here. When the market crashes, it all tends to come down together. Like, why is that? Because a lot of it is in ETFs, and people sell the ETFs, and the ETFs are forced to sell. A lot of it is fund managers that they're forced to, liquidate their investments when everybody is trying to panic sell at the same time. And stocks do all go down at the same time. And so I have remained a large proportion of my portfolio is in cash, and I've kept this all the time. Pretty much, particularly from kind of November, December, my proportion in cash is maintained very, very high. And I've still managed to beat the index, which I'm very happy about, because I was like beating the index, but I was like 40% cash, which I'm happy with, because obviously almost half of it's in cash, right? So that meant that I was almost doubling what the index would be had I been fully invested. But the point is that I wasn't fully invested. And that's because I wanted my risk-adjusted return to be right in the event that there was a crash. So what am I doing in the event that there is a crash? I'm holding a large proportion of my portfolio in cash. And that's where the real money can be made, because you take advantage of opportunities when they're really, really cheap and nobody else has the liquidity to do it. This was why people like Seth Klarman held like 30% of their portfolio in cash. And it wasn't when the stock market was sky high and everyone else was making 20% a year and he was making 30% a year. That's not where he made his money. He made his money when everyone else had lost so much and they're all selling out and they were selling low and they had no other option because they had no liquidity or nothing. He was able to go in and buy prices because he kept that liquidity to do it. So that's my first strategy. The second strategy, and it's funny you mentioned this clothing brand with this 12% yield, because I am investing in high yielding companies at the moment. But the key thing is I do a lot of research on the dividends, a lot of research, and like I make sure they're stable companies. They're usually in like non-cyclical sectors, things like pharmaceuticals. They're yielding high, and like what makes sense to me in my head is that if they're yielding high, eventually the market is going to keep that floor on that share price for income, right? So like say, for example, you have a stock like the tobacco companies, right? So if you look at Ultra, which I've done videos on, if they're yielding 7% at the moment, if the stock price of Ultra halved, the dividend yield would be 14%. As long as they can keep maintaining their dividend payments, which from my analysis, I think they can, is the yield going to remain at 14%? Or are investors going to go, look, we've got crazy low interest rates, the stock market's crashing, where do I put my money? There's a 14% yielder here. That's great. If they're already yielding 7%, I think it creates a really good floor on the share price, coupled with the fact they're in a non-cyclical industry, coupled with the fact that the history shows they have low betas. These are the kind of companies I am investing in at the moment to generate me some income and to generate me some upside if the stock market continues to go up. But they have high dividend yields in kind of non-cyclical industries that I think they have a much greater probability of not only surviving the crashes, but having much lower downside. And then having that proportion of cash allows me to take aggressive advantage of all of the opportunities when these amazing companies that I've wanted to own, that I can't own because they're overvalued, I can then go and own them when everyone else is saying, forget investing, I'm out, this stock market is useless, I've lost all my money. That's when the real investors will make their real money because they've got that liquidity.
So you mentioned Altria. So I don't know if you've been following the news last week, but
I know what you're going to say, yeah.
So Joe Biden came out and he talked about actually making it mandatory to reduce the amount of nicotine and cigarettes here in the last week. And so on that news, a lot of these cigarette companies, Altria, Philip Morris, actually took a dive. Yep. But I was thinking about actually, it might be actually a really good opportunity to buy a cigarette company, because if let's just say if Joe Biden does go forward and make that happen, where they actually have to reduce the amount of nicotine in cigarettes, I would think that people that actually smoke cigarettes would then just probably smoke more to get the same amount of nicotine. So I would think that, one cigarette may not be enough. They may have to smoke 2 cigarettes at the time. So, I think the companies actually could make more money off this, right? And then not only, and the other thing is the companies actually have dropped. I think Philip Morris actually has gone up a little bit because they had some good earnings this past week.
It's because they're international. So Philip Morris is Philip Morris and Ultra, they used to be the same company. Philip Morris span off from Ultra. Ultra is 100% US. Philip Morris is 100% international. So basically, Philip Morris is actually net positive on the news. I think the reason why that happened is because obviously people were selling out of people like British American Tobacco and Ultra, and that money was being moved into Philip Morris because they're not US. They won't be affected by the ban.
Interesting. So, okay, I didn't realize that. So, yeah, so I think it's a win-win scenario in my mind. It's like either, okay, the stock has dropped, so it might be a good value right now, plus that amazing dividend. And then even if or you could buy it then if the the laws don't change, or even the laws do change, you might still make out really well because people might buy more of the product. Right. So yeah, that could be a really, really interesting sector to invest in. I don't know what we are on time right now. Almost like at an hour, pretty much.
Almost an hour. Okay. Shall I give my thoughts on that, and then we can wrap up?
Yeah, I think that'd be good. Yeah, let's do that.
Okay, awesome. So, tobacco, really, really interesting because I have, as you may know, a fairly large proportion of my portfolio in tobacco. It's about 15 to 20%. I owned Philip Morris, which did very well. Ultra, which did terribly, has rebounded a little bit on that news, but did terribly when the news came out because they're 100% US. And also British American Tobacco, which has kind of been in the middle because they have a fair amount of US exposure, but they're still a very global business. So my view on it is that it's very, very hard to quantify how that effect will come about. What you have to remember is it's crazy how much the stocks dropped because this is just a very, very early stage news, right? It's like reported by the Wall Street Journal. Biden may or may not reduce nicotine. I think he was like trying to ban menthol, and like he was going to reduce the nicotine amount of nicotine in cigarettes by half or something with the menthol ban. But it's really, really hard to quantify how that is going to affect cigarettes. You do bring up some good points. You think if there are people who, they're smoking and they are smoking because they're addicted to the nicotine in the cigarettes, they might have to smoke more to get the same high. That is a very, very valid point. On the flip side, you could think, if the nicotine is halved, and I'm aware a large proportion of people that smoke want to quit, that might be the final catalyst that allows them to quit smoking. And then these tobacco companies have got a big problem on their hands. I had a small gathering, a small party at the weekend, and there are some people who they don't smoke because they know the addictiveness of cigarettes. Maybe some people would smoke casually more if they knew it was less addictive. But then there are also a lot of other health implications of smoking cigarettes that aren't to do with the nicotine. These are all things we have to weigh up. I think Ultra, at least one thing to say, is that they're doing really well with their diversification strategy. Like they have their investment in Juul. They have other kinds of non-combustible tobacco investments going on. They own 45% of Kronos, which is in marijuana. That's something we might be able to see legalized. But I think in summary, what I wanted to say on the point is that it's very, very hard to know, wave my magic wand and try and quantify what a law may or may not get passed and will have an effect on the company, right? We don't know what year it's going to be passed. We have no idea how that will impact cigarette sales. It's all speculation. And this is maybe something that tests your stomach as an investor. But what I will tend to say is that, the market does tend to be very overly pessimistic on these things. And for a 12% drop in Ultra in 2 days of a law to just reduce nicotine cigarette consumption that the Wall Street Journal was speculating on seems very steep to me. And it might have been a buying opportunity. One of my mates asked me, like, are you going to buy more? And yeah, I certainly would have considered it. Obviously, I didn't just because I'm so exposed to the cigarette market already. But plus the added thesis on the cigarette companies, because they're such high yield, what I mentioned to you before about giving them the floor in the share price, I'm perfectly happy to keep holding them for now. And it's only when I can actually quantify this new information and update it in my valuation models will I kind of alter my buy sell decision and my target prices.
Okay, interesting. Yeah, I didn't realize you were that heavily invested in the cigarette industry just in general, but yeah, interesting. So yeah, I think we'll probably have to call it. Yeah, we're just at a little over an hour right now, it looks like.
Awesome, Justin.
So this was awesome. I really enjoyed this a lot. I think our conversations flow really well. This is a lot of fun. So maybe we can do this again in the future. I think there's a lot more we could talk about easily.
Absolutely. And please let us know what topics you'd like to see, because we covered a vast range of all kinds of stuff today. Valuation. We did specific stocks. We did a bit about our background. If you enjoyed this this call and this discussion, please let us know, and let us know what you would like to see, topics for the future. We can get some audience members giving us questions on here, Justin.
Yeah, exactly. Yeah, we get some kind of question answer session going. That'd be a lot of fun too. Give some more, layers to this discussion just in general. So yeah, thank you guys so much for watching. Really, really appreciate it. And we'll catch you guys on the other side.